Welcome to our deep dive into the world of investment portfolios. Many investors, especially those early in their journey, become obsessed with finding the perfect portfolio. They read about buy and hold strategies, keeping costs low, and the benefits of passive investing. But as they learn more, they realize that the so-called efficient frontier, the optimal mix of risk and return, can only be defined in hindsight. The truth is, no one can predict which portfolio will outperform in the future. The key takeaway: there is no perfect portfolio, only reasonable ones that fit your needs and risk tolerance. Let's explore why picking a good portfolio and sticking with it is more important than chasing perfection. You might wonder why there are hundreds of portfolio models out there. The answer is simple. Every investor has unique goals, risk tolerance, and circumstances. Over the years, experts and enthusiasts have designed portfolios to suit different needs, from ultra-simple to highly complex. Some focus on stocks, others on bonds, and many blend both with alternative assets like real estate or commodities. The abundance of options can be overwhelming, but it also means you have the flexibility to choose what works for you. Remember, even the most complex portfolio may only outperform a simple one by a small margin, and that edge can be lost to fees or poor behavior. So you've chosen a reasonable portfolio. The most important thing is to stick with it. Constantly changing your investments in response to market trends is like driving while looking in the rearview mirror. Even seasoned professionals fall into the trap of tweaking their portfolios too often. Instead, pick a mix of assets you believe in and can commit to for decades. Over time, every portfolio will have its moment to shine. The discipline to stay the course, rebalance periodically, and avoid emotional decisions is what truly drives long-term success. Start with the simplest portfolios. Some investors put 100% of their money into a single fund, like the S&P 500 index or a total stock market index. These portfolios are easy to manage, low cost, and have performed well over the long term. For example, a two-physician couple invested only in the S&P 500 reached a net worth of $1.2 million within a few years. While these portfolios are heavily weighted toward large U.S. companies, they can still be effective if held for the long run. Simplicity can be powerful. Taking diversification a step further, some investors choose a total world stock market fund. This approach includes not only U.S. stocks but also companies from around the globe. The advantage: broader exposure and reduced risk tied to any single country's economy. With expense ratios now extremely low, global portfolios are more accessible than ever. While they may not always outperform U.S.-only portfolios, they offer peace of mind through diversification. Those who want both growth and stability, balanced funds are a popular choice. These funds combine stocks and bonds in a single package, often with a 60-40 or 50-50 split. Examples include the Vanguard Balanced Index Fund or Tax-Managed Balance Fund. They offer instant diversification and are easy to manage, making them ideal for investors who want a hands-off approach. The balance between stocks and bonds helps smooth out the ride during market ups and downs. Target date and life strategy funds take simplicity even further. These funds automatically adjust their asset mix as you approach retirement, reducing risk over time. You pick a fund with a target year close to when you plan to retire, and the fund does the rest. Life strategy funds offer fixed allocations, while target date funds gradually shift from stocks to bonds. Both options are great for investors who want to set it and forget it. One of the most popular approaches is the three-fund portfolio: U.S. stocks, international stocks, and bonds. This simple mix covers most of the global market and is easy to maintain. It's favored by the Bogleheads community for its balance of diversification, low cost, and simplicity. While it leans toward large-cap stocks, it's a solid foundation for most investors. You can always add a fourth fund like real estate or small-cap value for a slight tilt. Investors prefer to slice and dice their portfolios, adding more asset classes like REITs, small-cap value, or emerging markets. The idea is to capture different sources of return and reduce risk through diversification. Portfolios like the Four Corners, Coffee House, or Ultimate Buy and Hold use multiple funds to tilt toward specific factors. While these can offer slightly higher returns or lower volatility, they require more effort to manage and rebalance. Beyond stocks and bonds, some portfolios include real estate, commodities, or gold. Examples like the Talmud portfolio or permanent portfolio allocate significant portions to these alternatives. The goal is to hedge against inflation, deflation, or economic shocks. While these portfolios can reduce volatility, they may underperform during strong bull markets. It's important to understand the trade-offs before adding alternatives to your mix. Factor investing involves tilting your portfolio towards certain characteristics, like small-cap or value stocks, which have historically outperformed the broader market. Portfolios like the Larry portfolio or those using DFA funds focus on these factors. While the potential for higher returns exists, these strategies can be more volatile and require strong conviction to stick with during tough times. Factor investing isn't for everyone, but it's a valid approach for those who believe in the long-term data. Modern investors have access to robo-advisors like Betterment and SoFi, which build and manage portfolios automatically. These services use algorithms to allocate your money across various asset classes, rebalance regularly, and even optimize for taxes. They often use low-cost index funds and offer a range of risk levels. While convenient, it's important to understand the underlying investments and fees. Robo-advisors can be a great solution for those who want professional management without the high cost. Some portfolios rely on actively managed funds like the Wellesley or Wellington funds. These funds have long track records and can offer solid returns, but they come with higher fees and less diversification compared to index funds. While a few active managers have outperformed, most do not, especially after accounting for costs. If you choose active management, be sure to understand the risks and monitor performance closely. No matter which portfolio you choose, regular rebalancing is key. Over time, some assets will outperform others, causing your allocation to drift. Rebalancing brings your portfolio back to your target mix, helping you manage risk and stay disciplined. Most experts recommend rebalancing once a year or when allocations deviate significantly. It's a simple but powerful way to keep your investment plan on track. After reviewing 200 portfolio options, the real secret is clear: consistency beats perfection. Whether you choose a simple 3-fund portfolio or a complex slice and dice approach, what matters most is sticking with your plan through market ups and downs. Avoid chasing the latest trend or switching strategies based on short-term performance. As the saying goes, the enemy of a good plan is the dream of a perfect plan. Pick a reasonable portfolio, rebalance as needed, and stay the course for long-term success.